We've been tracking the gold-oil ratio as an indication of the health of the economy. So how do these elements all fit together? Simply put, the gold-oil ratio tells us how many barrels of oil one can purchase with 1 ounce of gold. Now, the ratio's long-term average usually holds at 16:1 and normally ranges between 10 and 30:1. And because both these commodities are denominated in US dollars, they share a loose correlation, and the prices tend to move in the same direction. And here's how. When the price of oil goes up, this will feed into higher inflation rates, as energy comprises about 1/3 of the consumer price index. And because inflation goes up, investors will run to gold, considered to be a natural hedge against inflation. This in turn then will also increase the price of gold. So in short then, oil price goes up, leads to inflation rising, leads to the price of gold going up. But there's also another mechanism at work here. With the price of oil going up, it increases the input cost for gold mines, which then ultimately makes gold more expensive. So what insight can this gold-oil ratio provide into the health of the economy? When this ratio increases, it reveals two things. One, there are upwards inflationary pressures in the economy, which will ultimately slow down economic activity and growth. And two, investors may be running toward a gold safe haven, as there may be too many future uncertainties hovering in the market. Both can therefore be used as a gauge of the temperature of the economy and what could be expected going forward. So currently this ratio is trending up towards that 30:1 mark, which, if we look back, discounting the COVID 2020 period, is the mark where this ratio tends to peak before making a swift return. This above average gold ratio is currently being fanned by investors seeking refuge in gold amid uncertainties with a variety of elements: interest rates, inflation, growth, US banking stress, all scaring the market. Meanwhile, the price of oil is declining despite OPEC's efforts to keep it elevated through production cuts. The ratio is therefore pointing to an economy that is, one, in poor health, and secondly, that a recession may in fact be just around the corner.